And we'll start this one off with some music. All right. How you doing, friends? Yes. There we go. How you doing? This is the 0 Days to Expiration podcast. This is number 104. Haven't done a podcast for a little bit, not since October. Going to get back into the swing of things. I want you to know that the beginning of next year, there's going to be some changes in the format in the content that I put out. I have someone that I'm working with that's helping me out with production. And so we plan on putting out at least 2 podcasts a week and then also a final hour show. So it's going to be pretty good. We'll have structure and come up with some very interesting topics to talk about. And today is an interesting topic because it was something that some people within the service had asked me. Actually, I asked them to tell me what they really wanted to hear about. And it really relates to today. Today is, just for context, is December 15th, Thursday, December 15th, the day after the Fed had increased the short-term rate for 50 basis points. Now, this is the first rate hike that has been a little less than previous rate hikes. We had a string of 75 basis point hikes and now this 50 point. And I think when the market looks at something like that at first, and I think their expectation is that, okay, the Fed seems like they have things under control, and maybe inflation is within their grasp, and perhaps a 50 basis point hike would imply that next year, 2023, that the Fed would start slowing down on rate hikes, maybe stop, maybe even pivot and go the other way. So the market gets excited about that. And so it naturally, after the rate hike comes out, it goes up. And then, of course, after every one of these Fed meetings, you have the narrative, the Q&A. So first comes the narrative. Jerome Powell comes out, starts talking about the state of the economy and how they are really kind of befuddled on how inflation got out of hand, how it started, how it's going to get controlled, where it's going. Really, it's just an amazing sight to think that they have 400 PhDs behind the scene and they don't know what's going on. Now, either they are feigning or lying, or they just really don't know, and it's just one big experiment. So he gets on there and starts talking rather bearish. Hawkish is another way to put it, which is contradictory to the hike itself and the minutes that come out. And the same thing happened a couple of weeks ago, where they come out with the minutes. The minutes seem rather subdued, and then he follows that up with a narrative and then a Q&A, a presser. And he sounds extremely hawkish, and the market's confused, and it comes down. So I get the feeling that the Federal Reserve likes to keep everybody on their toes. They speak out of both sides of their mouth. They let their reports say one thing, and and then the narrative says the next thing. Now, of course, after any one of these events, you'll have all the different Fed governors come out, and they'll be on their speaking tour, and they'll all shape what they really meant by whatever Jerome Powell said during the Q&A presser. So what does this have to do with trading zero DTE? It has a lot to do with it, because one of the biggest questions that we have on days like today, where you have a huge move down, an outlier move, how do you predict something like that? How do you put a trade on that will handle that kind of a move? Well, the first thing I want to say is that there's really no way to predict exactly how the market's going to react to the Fed or any of these binary events that might happen, whether it's the Fed or the CPI or the PPI or minutes coming out. You just don't know. You do know, though, that volatility typically will, or implied volatility will typically rise into the event, and then after the event, it will fall dramatically, something they call volatility crush. So those two events, those two things are things that we can play, or we know are going to be in our advantage in the way we put on trades. So, and the reason for that is that we're doing premium collection as 0 DTE traders. And typically, premium collection strategies like the one that we use with the butterfly are vega negative, meaning that the negative, meaning that if volatility is coming down, that's good for the strategy if you're in the strategy. So, in other words, premium will rise faster on a whole if volatility is coming down. Now, so if you're in that strategy and it's after the event, you're assuming because you have volatility crush, volatility is coming down and premium will start rising more quickly. Of course, we're only talking about a single day and perhaps only a few hours. And so you have volatility coming down and premium going up, but you also have the time expiration that no matter what, that can't change. Now, volatility can change. It can change. It doesn't necessarily mean that just because the event happened that volatility is just going to fall like a rock. Sometimes it does. Sometimes it falls hard. Sometimes it kind of meanders its way down, and other times it just sort of stays flat. But what doesn't change is time. All right. So what I'm really telling you is that there's all of this variability in the market that you cannot predict. You don't know how the market is going to interpret the Fed, how they're going to interpret the aftermath, or any of the Fed governors that come out after that, or the compendium of economic reports that are going to follow up on that, because that is producing or reporting data that the Fed is supposed to be looking at and making their future determinations. So all of these things are coming into the market, causing all kinds of mayhem. Sometimes the market will shoot up, it will shoot down, it will do nothing, and you just don't know. For the most part, as traders, we enter the market and we play the market. And that's really the answer. How do you play days like today? You don't play them any different. You look at how the market and its collective intelligence is telling you how the market is likely to behave. Beyond that, everything is just a guess. So sometimes the market will give you an expected move and say, the move the market expects is going to be 50 points or 100 points or 20 points, whatever it is. You just don't know. And even that is typically not something that you can rely on, because the expected move is generally something that is calculated inside of your trading platform, and it's based on a faulty set of assumptions that volatility is static and liquidity is static, and neither of those things are true. But it's the best thing that you have to go on. So what we do is we take a swag. A swag is I believe it's a military acronym that stands for Scientific Wild Ass Guess. It may also come from NASA or some other agency or whatever, but that's what it means. And what that generally means is that we're not taking necessarily a guess. We're taking an informed wager. And it is a guess. I mean, any kind of wager is obviously a bet. It implies that we don't know exactly what's going to happen. We're going to play the odds, the probabilities. And on days where there's an expected move that is larger than others, then that's going to dictate where our strategy will be placed. Now, we won't be counting strikes or doing some sort of calculation to try to figure out where price should be. That will all work out for us. The pricing in the market itself will naturally put our strategy where it needs to be just by following certain sets of criteria. And our criteria are pretty simple. And that is that we take a certain risk to reward. Now, that might be a little bit misleading in saying that it's, whatever that reward is. we're trading butterflies. We trade out of the money butterflies, meaning that they're essentially directional trades. We push them far enough out of the money that they give us a certain ratio between the cost of getting in that butterfly and the maximum profit that you could potentially obtain if price happens to end up right at the short strikes of that butterfly. Now, we don't know that that's going to happen. We really have no idea. However, when we get into that trade is kind of important. So if we know that there's a higher level of volatility, if it's going up or down, we can somewhat time that trade to get the best price possible. We want to put it far enough out of the money so that we get the type of risk to reward we want. We have a certain ratio that we're looking for that's anywhere from 1 to 7 to 1 to 10, a ratio between the maximum profit and the cost of getting in that trade. We can also choose how wide that we want to make the spread, and that will also have a very, very specific effect on the behavior of that strategy over the course of the day, and how premium decays, and at the rate at which it decays, and what we can expect. So putting on a narrow fly, for instance, very early in the morning is probably suboptimal. Putting it on later in the day or closer to expiration, you're going to have a better chance. Putting on a fly that has a certain width will give us sort of what we would call our sweet spot. So we look for trades that maybe 1 to 7, 20 wide, and that is kind of like in the middle of what we like. Of course, if we put a trade on that is just 2 strikes wider, a 30 wide. Now this is wide per side, so 30 wide is actually a butterfly that's 60 wide. You're going to get very different characteristics to that trade compared to the 20 wide. The rate at which premium decays in that trade is significantly more. However, that all really comes down to the size of your account too. So that's another consideration that you have to make. What is your minimum or maximum size position that you're willing to take on? Because a 1 to 7 20 wide is going to cost you around $2.50, but a 1 to 7 30 wide may cost you $4. Can you afford $2.50? Is that within your risk, your risk parameters? Or is $4 within your risk parameters? Can you put on multiples of either of them? So those are the choices that you make. You can also make different choices in terms of, I want to put on a 1 to 7, or I want to put on a 1 to 10. If you feel like there's going to be a huge amount of volatility and great movement within the market, you might want to opt for a higher ratio in that risk to reward. You end up paying less as a percentage of the total width that you put on, but that's the risk that you want to take. So we have that kind of variability and choice that we can make depending on what the market is. Typically, if we have a very volatile market, we'll want to put those trades on earlier, put them on wider, and put them on further away from the money. If we have a very subdued market, we want those trades to be relatively narrow and put them on closer to the expiration time, and that makes more sense. So you have that kind of range, but still we're within our ranges, our swag, and from that, of course, there's a decision that you have to make. Which one do you go with? And a lot of that is based on your personal experience with the market, how that market's behaving, what your personal risk to reward or your personal capacity or tolerance for risk. All of those things come into effect, and you make a decision. You make your swag. So that's the answer that I want to give to the members of the service, that there is no magic formula that you use to place a trade. There are a number of criteria, things that you have to take into consideration. Firstly, your tolerance and capacity for risk, the knowing the ranges at which we have to deal with and the market conditions and what type of trade tends to work best with a very volatile market or a range bound market or a very subdued market, one where the volatility is very high. Maybe the VIX is up in the 25 to 30 range, or maybe it's down below our Goldilocks zone before, down below 17, or it's in the 15s. And so all of those cases will demand that you at least move to one edge of your range of criteria or the other. The other part of that is just, what is your personal experience? What has worked for you? And so with that, we spend a lot of time analyzing our trades. So we put the trades on, we try to put them on with some sort of regularity within our basic criteria based on our knowledge of that market. Largely, we're putting on directional trades, but we do have also a semi non-directional trade that we call the Batman. And so we'll put that trade on under certain conditions when we're not as sure. If we have a feeling for direction, then we'll put on what we call our classic trade, which is either above the market or below the market. And it really doesn't matter because our win rate with that kind of trade is about 50-50. But generally, if you think that we're in a trending market going up or going down, then you'll put it or place it appropriately. That all makes sense. As we go on in the course of a week, we put on all these trades, we log them, we journal our trades, we look at what we did. Now, of course, putting on the trade is only half of the effort. The real effort in what we do is the management of the profits. So that's where the rubber meets the road. We put on these trades in such a way that our risk is extremely small, so we don't have to manage the risk. Our risk is defined. The risk management is built into the size of the trade, at least for the directional single classical trade. That's true. For the Batman trade, where we put on 2 flies, we have very, very simple risk management rules. Everything else comes down to our management of profit. Because what we're trying to do is capture the maximum amount of profit. And if possible, if the market cooperates and we get lucky that day, perhaps it will end up right on the short strikes of one of our flies and give us what we call a pin trade, where we can make as much as 1,000, 1,500% on our risk. But most of our trades are going to be smaller trades that are, by most option traders' standards, are still very high, usually a return of anywhere from 50 to 300% on our risk. That's what we're looking to manage. So that's what it really comes down to when we're trading the zero-DTE way. It is all about taking these asymmetric trades, putting the odds in our favor, the best that we can, defining our risk so that it is of little consequence. I mean, we don't really have to worry about it. We're not in that mode that most traders are in, and that is managing their risk, or what I like to say is managing their losers. Instead, we take the opposite way. We invert the entire equation, and we're no longer managing risk. We're now managing profits. So that's really the answer. That's how you approach even a day like today. I had no idea that we were going to go, I don't know, 30, 40 points outside of the expected range. Should I have expected it? Why? I don't know. Maybe. Now, with today's trade, one of the things that we could do is maybe take a little preemptive strike and maybe get even a little bit wider based on the situation. Because we know that after Jerome Powell speaks or after the Fed makes a significant move, there is a good chance that we will exceed the expected move. So what we do is, instead of trading the SPX during the day, we'll trade the E-mini S&P futures, options on the futures, and trade them the night before. Still within the same session, because if you know futures, you know that they actually open the session the night before at 6 p.m. Eastern Time. So that night, we'll evaluate the trade and see whether or not we have good pricing. And you can tell it right off the bat. The other day, we were able to put a trade on, and it was amazing. We got very close to the money. But we were able to put on a Batman trade, both sides of the market. put on a 1 to 11 risk to reward and very cheap at the cost. We put a 1 to 11 risk to reward trade that would normally cost us $5 or $6 for like $2.50. That was crazy. So we don't, hey, that's fine by us. We'll put that trade on. And we were successful. You don't always get those opportunities. You try to put that same trade on last night, and that exact same trade would have cost you $6 or $7. So you couldn't do it. You could put on a 30 wide for maybe $3. And that was, again, within our risk parameters. So you do that. And of course, based on the way the market was pricing them, it put them much further apart. So it naturally adjusts based on what the market is telling you to expect. So it's almost like you don't really have to think. You just have to, well, that's not true. You stay within your guidelines, you use your best judgment, your swag, and you place the trades according to what the market's giving you. You play essentially the market. You play what the market tells you what you should play. So that's the best way to answer the question. Hopefully that sits with you too. I mean, it's a fantastic way to trade. Trading the asymmetric way with very small risk and large potential reward has its own rewards. And the biggest reward is that we're never in any kind of panicked situation. We're not sweating our risk because our risk is always super small. We're always on the side of trying to manage our profits, which is more of a high quality problem as opposed to getting panicked and worried about how much we could potentially lose. And that, in effect, is another edge that we have. Because we can trade in this calm and sedate and in this kind of reasoned manner, we can make logical decisions. We can make cool-headed, logical, reasoned decisions. And that, like I said, really gives us another edge besides the edge that we already have with premium collection on the last day of expiration and all of that explosion. It's really a great way to trade. So if you're interested in doing that, go to the link below, go to 0-dte.com/try, sign up for our 4-week trial. All right. So hopefully that was informative. You understand then how we trade markets like this. Really what it comes down to, not much different than we trade any other market. The market tells us basically what to do, and then we do it. Taking our best swag, journaling and logging everything that we do. At the end of each week, we then review all of that, come up with our best trades, log them, categorize them, do that week in, week out, develop our process, make sure that we're staying true to that process, developing habits that if we find that we're developing habits that maybe take us off of that path, then we'll develop habits that will recorrect those. I mean, our process is really nothing more than a series of good habits that we maintain. And we do that by being totally focused on what happens. All right. Well, that's pretty much it. I think we can then now go to the chat and see who's hanging out there. Say hello, do a little roll call. And of course, we have Dan Smith. How you doing, Dan? Dan's here, with his double barrel hello, and Jay Hen. Now, by the way, the trade that I put on last night, it overshot it, and there was nothing I could do, so I took it off with a small loss. However, the last 3 days were really very, very good winners for us. Some of them close to pin trades. Just thought I'd throw that in. Robro's here. How you doing? He likes the music. El Salvaje Lanza. I hope I'm not screwing that up. But thank you for showing up. Maiko's here. Yo. And Max Virtual. Haven't seen you for a little bit. Hey, Eugene. Nice to see you. And Craig, I hope you got your mobile situation under control. Donald Steele's here. How you doing? Yeah. Hello. And Jonah, nice to see you here. Thank you very much. And of course, Ty. Thank you all for showing up. Let's see, what do we have here? It is 328. The market has moved down dramatically since last night. Let's see where we closed yesterday. We closed at around 40.30 or so, and we got down as low as um, 39.08. Wow. So 120 plus points. And I think the expected move was only about 60 or 70 points. So I don't know. How do you play that? Even if it was 80 points, it might have been 80 points. I don't know. I know it was that the day before. I doubt it was that last night. I don't really know how you play something like that with any kind of forethought. I mean, we couldn't expect that there's a chance that we might go outside of the expected move, and so for that we'll play much wider and then play the night before and try to get really good pricing and really good width and span and try to spread things out. But even then, the price went beyond uh, those limits. I mean, you make a 100 wide net to try to catch price, and it still goes beyond that. There's not much you can do. Fortunately, because of the way we structure our trades, that risk is very, very small, and we're able to take it off very quickly and hardly any loss at all. So that's cool. We have more people showing up. We have Miguel. How you doing? And one, two, three, Happy Streets here. Joseph Tance, what's up? Let's see. Is says looking for the push and pin on SPX 3910. Oh, nice. So what I do isn't necessarily what everybody else in the group does. Let me just say this, that this is not an alert service. This is a coaching and mentoring service where my goal is to help every trader that enters this service become the best that they can be, to become a professional trader and to become an independent trader. They pick up the strategy, they pick up the philosophy, the process, and then they develop their own style of trading. And so while I might trade one thing, and a lot of the newer traders are following along just so that they can get the cadence and understanding of what we're doing, people that have been here for a while are trading their own thing. And there's a case in right there that is still looking to make something out of this. All right. Let's see. Milo's here. I used volume VRP and put on a single 3915 ES. Okay. At the LVN. All right. So he's using he's using lingo that is within our group. Now, one of the things that we do when we're managing our profits, putting on the trade is one thing. There used to be a time when we did a lot of analysis in the beginning, thinking that we had an edge up on doing geo macro analysis. And to some extent, there's still a little bit of that. And you use your best judgment in terms of what edge of the ranges of things that we like to trade based on market dynamics and what's going on in the world. So, and we also used to use volume profile to try to place things very, very precisely. And you can adjust your trades in such a way that you have a backstop, or you're within liquidity zones and non-liquidity zones, and we use the volume profile to determine those things. And so when he's talking about an LVL, that's actually a non-liquidity zone, the lowest point on there that we mark up, that has a kind of, well, it's part of the market structure that will show you where inflection points are. And we mostly use that stuff in the profit taking and in our analysis of price action along with the volume profile. And that will give us our a way of looking at the market where we can anticipate behavior of the market and where it's going to interact with the market structure. And so that's how we use volume profile. Oh, Milo says the same as is. Yep. Oh, it's a final hour trade. So, right. So naturally a narrower trade using the volume profile and the market structure to try to place a trade in what appears to be the most opportune place. Cool. All right, Craig, we'll get that fixed for you. All right. So one thing that we'll be doing in the future or revisiting is final hour trades. We'll start looking at that more regularly. I have to come up with a cadence for the final hour show. The way it's going to work, I want to do a final hour show every day. And sometimes we'll be doing that in the context of a trade that we are currently curating. In other words, it's within our design life cycle of any particular strategy that we're trying to develop. And we will do that publicly so that you can see what we're doing and see how we go about the business of developing a trade, like we did with the final hour trade. I did 100 episodes on a specific type of trade. We didn't end up adopting that based on that work. Now, we have other trades that we want to put through that same kind of ringer, that same kind of process, and curate it. And one of them that is very new to us is that one that I had mentioned earlier, the Batman trade. We are still in the process of developing that. And so most of the work on the Batman trade is really on the back end, the profit taking and the risk management. And so we'll start in these final hour shows concentrating on the work that we're doing there. So if you're watching, and you'll be able to see how we actually go about managing and also developing our zero DTE trades. All right. Michael says he has a 3930, 10 wide here. So he's just about pinned. So he's getting, well, near pinned. So he's getting out now with a nice profit, I imagine. Very nice. Good work. All right. So that's about it. Hopefully this was an informative show for you. We'll be on tomorrow. Tomorrow is a quad witching day. Today is the last day for the December contract on the futures. So it's the last PM expiration. And tomorrow will be the switchover for a lot of the futures contracts and also options contracts. So tomorrow we'll be switching over to the March contract, which is designated by the symbol H and 23 for the year 2023. Futures, at least index futures, go quarterly. We just got finished with the December contract, which went from September to December, and now we're going from January to March, and then the next one will be to June, and then September again. So it's a new contract tomorrow, at least for the futures, if we choose to trade that. And of course, all of the various options and futures and everything come to a head tomorrow, where they have this event that's called quad witching, and that should result in a little bit more volatility than normal. Although I don't know how you get more volatility than we've had over the past week with the PPI, the CPI, and the Fed doing a rate hike, and Jerome Powell acting like a super hawk. Then we have quad witching, which is going to be nothing. All right. So thank you very much for showing up. That's all I've got. Peace to you all, and we'll see you tomorrow with another final hour, 0 days to expiration. Music. Peace to you all.